Hello, everyone. Thank you, everyone, for attending today. We are about to start. We have Rick with us today. And we're going to wait 2 more minutes so everyone else can join us. If you mind answering the poll that appears on the screen, so we know you're already an existing Real Estate IQ subscriber, and if you would like to have a one-on-one consultation of our services. Also, feel free to write down in the chat box, where are you from where are you watching us, so we get to know you better and we can network. We're very happy to have you all here. And we are starting now. I'm sorry, I don't know why my presentation is not working properly. Okay, so thank you again, everyone, for attending today. Thank you, Christine, for sharing. So we have people from Jacksonville, Florida. We are very, very excited to have you all here. Okay. So if you have any questions, please use the chat box or the Q&A box so Rick is able to answer them as soon as possible. And we are Real Estate IQ. This is the streamline your deal-making process. So these are the solutions that we provide. We offer off-market leads, EBA, CMA, custom leads, mining, and virtual assistants. So if you're looking for more, please try our exclusive membership. These are our social media accounts where you can follow us as well. We are in Instagram, Facebook, LinkedIn, and YouTube, and you can use the QR codes that appear below of each icon so you can join us in our community. And you can also use the QR code that appears on the right side of the screen so you join us in our newsletter so you don't miss any of our weekly webinars and in-person events. Okay, so we also offer one-on-one consultation, a free 30-minute in-depth consultation of Real Estate IQ services with one of our experts. You can feel free to schedule it now by scanning the QR code that appears on the screen, also by texting Bracenet at realestateIQ.co or also answering the poll. This is a very short video of what we do. I hope it loads perfect. Okay, we are moving forward with Rick, that he is talking about the best loan programs designed for a high interest rate market. We were going to do a demo of the portal, but unfortunately, the person from our sales team is not able to attend. So sorry, Rick, for that, and thank you everyone for attending. I guess you have a really interesting question in the chat box, Rick, when you want to read it, and if you guess if you think you can answer it, I will stop sharing my screen so you can move forward with your presentation. And again, thank you everyone, and especially Rick for being with us.
All right. Hey, everybody. Trying to get into the chat real quick. Come on, please. That's where you said that? There it is. So to answer that question, from Jacksonville, Florida, possible, yes, probable, no. Right now, Fannie Mae, Freddie Mac, FHA, all will allow you to buy a duplex, triplex, or fourplex as a primary residence, with 5% or less down payment. Now, there's also a new program out from Fannie Mae that has a $5,000 grant. So, under the right circumstances with some down payment assistance or some grants, you could definitely buy a house with less than perfect credit as an investment and get started in the investing world with little to no money down. But again, FHA and the VA are everybody's gonna want 5% down on those products, or 3.5% minimum, and so you will be confined by that. All right, I'm going to share my screen and we can get started. All right, is the presentation up, Valentina?
Yes, perfect.
All right.
Yeah.
So this may be the last time we're able to do this presentation. I'm not sure how closely you guys are following the markets, but it does appear that rates are coming down, and it does look like the economic factors that affect rates the most are finally swaying in our favor. We should be crossing into the we should be getting into the sixes pretty soon here. Last time I checked, the average across the national average was about 7.1. So this may be the farewell song, but a lot of these programs are still going to be around. They're all extremely effective at getting you into the properties that you want to get, effective at helping you sell properties you need to sell. Really just, these products are all still going to be around, and they are available in less than in real estate markets that aren't rising. So we've all heard this: knowledge is power. Well, what if I told you that's not exactly the case? Anybody who's near my age knows G.I. Joe, knowing is half the battle. Well, if knowledge is not power and knowing is only half the battle, what is the other half of the battle? The other half of the battle is action. What are you doing with the knowledge? We all know how to lose weight. If you're anything like me, you're still carrying around those Thanksgiving LBs that you want to get rid of. So the best loan programs for a high interest rate real estate market are, so we've got FHA lending, always going to be a great program, has lowest interest rates of all the programs. You have first time home buyer programs, which consist of Home Ready, Home Possible, Borrow Smart, and Home One. We have reverse arms, or also known as buy downs, which is where the seller uses seller concessions and helps the buyer get into a loan that has that reverses an arm. So basically what it is it's just the first 3 years, and then it's fixed for the remaining 26. So for instance, right now, 7.125% interest rate. We don't really focus on the 3-2-1, but the 2-1's pretty common. The 1-0 is really common. The 2-1 means your 7% interest rate in year one is going to be 5%. And in year two is going to be 6%. And then in year 3 through 30 is going to be 7%. And I'll go over that a little bit more in later slides. We also have our non-QM loans, or non-qualified mortgages. These are non-conventional loans, alternative income loans. You may know them as bank statements, DSCR. all sorts of different loan types. And then, of course, private money and hard money for all of your fix and flips, for all of your buy, rehab, rent, refinance, repeat products, the burst strategy. All of that is available there. So with the FHA loans, they are government insured loans. They have expanded underwriting requirements, lower down payment. The standard down payment for an FHA loan is 3.5%. They have lower interest rates. They're usually about 0.5% lower than conventional rates. They have higher debt to income ratios. They'll let you go up to 56% as far as debt to income, whereas right now on conventional, it's supposed to be 50, but if you have a 50 DTI, we're having a lot of problems getting them approved. And then you have more lenient gift requirements. Gifts can come from anyone, anywhere. So if you have a wealthy family member, a wealthy aunt, uncle, sister, brother, mom, dad, anybody willing to help, you have the ability to get into what we were talking about with the first question, a duplex, triplex, or fourplex with 3.5% down. You live in one unit, stay there for a year, and then you can rinse and repeat, or you can go buy your dream home, because you should be living pretty close to rent free if you do the duplex, triplex, or fourplex. Then we have conventional lending. Conventional lending created by Congress. It's federally backed funds through Fannie Mae and Freddie Mac. You have personal income qualifications. They're pretty standard across all products. 5 to 7% 30-year rates, although really that could be 6 to 8%, even though it looks like the 8s are in the rearview mirror. They maximum of 5 finance properties unless you're buying a new primary residence. So if you have 10 properties today and you're going to convert your current primary residence into a rental, you could buy an 11th property with Fannie Mae and be excluded from the maximum 10 finance properties. And then you have to close in a personal name. Also with this program, conventional lending, they just raised the minimum loan amount to $766. That means that homes that are as expensive as $805,000 will now qualify for 5% down. You can do the 1.0 buy down and the 2.1 buy down, and you get all of the benefits of a 30-year fixed rate of conventional loans. Also, the reverse arms are done through here. These are products where you are going to the seller is going to pay for it first of all. They do have one where you can take a slightly higher, more expensive interest rate and do the buy down as well. I'm not sure how much sense that makes financially. Also, with the 2.1 buy down, if you refinance in 6 months, the money from the seller goes into an escrow account and it stays there. And you pay the payment that you pay, and then it covers the payment to the interest rate that you're going to be in, the fixed portion. Well, as that escrow balance diminishes, if you're able to refinance, you would get the balance of that money. So you don't lose this money like you would with a discount point. Whereas if you bought the rates down from 7% to 6% and rates go to 5%, and you want to refinance, but you haven't made enough payments to save the money, that money just kind of gets lost. So that's one of the big advantages of the buy down and the reverse arm. Then we have our non-QM institutional money. These are alternative income products. They're private and public institutional funds. A lot of these companies are, hedge fund funded. They have alternative income qualifications. So alternative income qualifications are the SCR, which is your investment property. We look at the rent and we look at the mortgage payment. Inside the mortgage payment, we have the principal, interest, taxes, insurance, and association dues. We'll go over more later in the file about calculating that, but it takes the rent versus that payment, and then it allows you to refinance the home and and get a 30-year fixed rate too. We have these rates are going to be 7 to 11%. They do have 40-year fixed, and most of the loans will be interest only. They typically do not have maximum finance properties, although most entities do not want more than 20 loans with a single person or entity. You can close in an entity name, and you can go up to 90% loan to value on all their primary residence products. Then we have our private and hard money lending. A lot of you already know about this. Private and hard money lending is basically it's institutional or individual funds. Like with my company, we are individual funded. We loan to person A, and then we turn around and we sell that loan to person B. They get the first lien position. We service the loan. We collect the payments. We pay the payments. That's basically the individual funds. We do not use income qualifications. Instead, we look at ability to repay. We have to verify that you have a job or you have an ability to make sure you can pay us the monthly payment, which will be based on an interest-only payment. We go off of after repair value or loan to cost, and we will typically go up to 75%. Right now, most of our loans are at 70%, just to kind of make sure we're mitigating the risk in this market. We have 9% to 12% interest rate loans, 6 to 24-month loan terms, interest-only payments. The loan term is determined by the size of the rehab budget or your project. If you have a project with a small rehab budget, but you're going to lease it back to the current owners for 4 months, we would look at a 9-month loan. If you have a project with a $75,000 or less term, we are going to do a 6-month loan. 75 to 150 is a 9-month loan. 150 plus is a 1-year loan. We have no maximum finance properties, and we will close in a personal name or your entity name. Alternative income products and how to calculate your income. So the alternative income products consist of a bank statement product, which will allow you to go up to 90% loan to value on a primary residence. So if you are someone who's either a little behind in your taxes, your tax filing, or you've been self-employed for a while, you had a really big year, you can buy a primary residence with a bank statement product with only 10% down. And that's typically up to $2 million loan amounts. We will go off of business bank statements. If we're using business bank statements, we're going to use between 50% and 85% of your deposits minus all transfers. If we're using personal bank statements, we'll go up to 100%. The 50 to 80, 50 is the standard. 85 if your CPA will write a expense letter for you stating that your company only uses about 15 to 20% expenses. We also have a 1099 and a profit and loss product. We're just going to go off of your 1099s. That's your income. We don't look at the bank statements. We calculate all your debt we do a 50% debt to income ratio, just like a standard loan. And we use your 1099s. Profit and loss are the same things. Very similar. They just will want to also have a letter from a tax professional. So just a licensed tax professional. We'll just have to take a peek at it. And then finally, one of the most common products is the debt service coverage ratio product. This is the DSCR. Compares your rent payment to your mortgage payment. Your rental income to your mortgage payment. And this is how you calculate that. So you have your debt service coverage ratio is going to equal your net operating income, also known as your rent, divided by your debt service, which is your interest, lease payments, principal repayments. And so in example 1, we have a rent of $2,350. We're going to look for the principal, the interest, property taxes, homeowners insurance, and homeowners association. And so we've got $200 in principal. We've got $1,064 in interest. So that's about a 7-something% interest rate. Property taxes are another $450 a month. Your insurance is $125 a month, which is going up. Make sure you're getting your insurance quote first on your properties right now. And then no homeowners association gives us a total of $1,839 for your debt service. So what does that look like? We take the $2,350 rent, and then we take the debt service of $1,839, and then that gives us our debt service coverage ratio, which is 1.28. 1.25 is considered excellent. We now will go down. We'll let you go negative. We have loans that will go down to 75%. If you just have a property that you just want to get fixed 30-year fixed rate on. So then this one is a little bit different. It's a $1,500 rent. So a smaller house. The principal is $150. The interest is $798. Property taxes are $300. We have homeowners insurance of $80. We have homeowners association dues of $50 this time for a grand total of $13.78. We take our net operating income, which is their rent, $1,500, versus our debt, which is the $13.78, and it gives us a 1.09. So anything above 1 is going to be good. Above 1.25 is going to be excellent. When we start going under 1, they're typically going to reduce our loan to value from 75 or 80%. They're typically want to take 5% away from your loan to value. So they would be looking at 75 and 70%. Next, we're going to look a little bit more into the private money. So private money, hard money loans. How do you calculate your cash at closing? How do you calculate your payment? So first, if you have a blank piece of paper, if we could grab it and just draw a line down the middle of it. And then on the left side of that line, we're going to write money I need. And on the right side, we're going to write money I can get. On the money I need is going to be the purchase, the rehab, the closing cost. And on the money I can, and then that's going to give you a total. On the money I can get is going to be the percent of the ARV. Like I said, most of ours are at 70%. And then we're going to have the total there. So first we're going to look at this. This example is a $245,000 purchase price, $75,000 rehab, closing cost of about $12,000 for a total of $332,000 for a project price. We're stating that the ARV is going to be $450,000. So we take 70% of $450,000, we get $315,000. So your cash to close is basically the difference. So that's about $17,000. So this loan, you will be able to get it closed and funded with about $17,000 cash out of pocket. We do, as a private entity, we do like to see some skin in the game. So we would probably want about $30,000 to get this loan closed. The numbers would obviously look a little bit different, but we would still make sure that they work to your advantage. If you're doing the BRRRR strategy, we would make sure that you can still get the maximum cash out on the refinance. And then if you're flipping it, we can, figure out how to make it work to your benefit for there as well. Same thing, example number 2, it's going to be slightly different numbers, but same concept. We have our purchase, our rehab, our closing costs for a grand total. And then we have our 70%, our ARV, and our 70 for that total. This one is $165,000 with a $42,000 purchase price. Closing cost of about $9,000 and a total of $216,000. And then we have on the other side, the money I can get is $280,000 ARV. At 70% is $196,000. So the difference is, if your cash to close equals the difference, so that's going to be $20,000 in this one. Oops. So the next thing we're going to do is we're going to, we can just pause right here. Are there any questions right now? We can email the PowerPoint to anybody who wants it. All right. So the next thing we're going to look at is how to calculate your private or hard money loan payment, or really any interest only loan payment that you may have. With this, basically, it's somewhat simple. You're going to take your loan amount and you're going to take your interest rate, and then you're going to divide it by 12, and that's going to get you a payment. So, we call this the quick and easy. So a $320,000 loan amount at 10.99% interest is 320 times 10.99%, and then divide that by 12. So it's a $2,931 per month payment. Now, whenever you're in an interest only loan, you have to remember that your mortgage balance it doesn't decrease unless you specifically apply funds towards principal. So one thing is that when you go to get your payoff, there's going to be a little bit of interest tacked onto your payoff. So in an example like this, 320, you made 4 payments. You still owe 320 plus the interest that will be owed in the time to get from the last month's payment to the payoff. So just something to kind of consider. This is the fast and accurate. So it takes your loan amount times your interest rate divided by 365 days in a year, and then times however many days are in that month. So on a 31-day month, it's 2,987. In a 30-day month, it'd be, 28, probably like 2840. And then in February, it'd be a really nice payment. So, you have all this knowledge. We just went over a few of the programs that are out there, and you utilize current lending programs. So, how are you going to be able to put these together to make the most out of it? Well, first you want to team up with local and experienced loan officer like myself. We can create flyers. We can hand them out at open houses on any properties you want to sell. You can also refer any client. Information is free. We try to educate everybody before we pull credit, before we do anything. You can get with your realtor, as the realtor, you can get with your sellers, pre-price in your concessions, let them know about the buy down products so that you can, mention it whenever whenever you're negotiating. Because if somebody has the ability to buy a house at 5% right now, that's going to make it a lot more appeasing than at 7%. We can advertise the buy down rate. Also know your market. Is their buyer an investor? Are they first time home buyer, or are they a fifth time home buyer? First time home buyers right now, home affordability is very big. Just about every state is working with affordable products. Most of the changes that we're seeing in the mortgage guidelines right now are moving towards home affordability. That's why we have the buy downs to help people get in the house for those first couple of years, allowing them to kind of work their way up to what the payment's going to look like once it's in the fixed portion. So just a bunch of different things. And right now with the first time home buyers, they have reduced interest rate, we call them loan level pricing adjustments. So right now they're reducing or removing them from first time home buyers. First time investor gets 15% down payment. So if it's your first investment home, you can buy it with 15% down payment. It is expensive. And then, like a fifth time home buyer, they're going to want different things. They're more established. They're probably going to put a lot more money down, maybe even pay cash for a house at that point. So, these are just all factors that, as a flipper or realtor, you really want to be considering. And again, the first time home buyer products are just, they're just getting stronger, and they're going to continue to get stronger while there's not a lot of supply on the market. And then also make it a win-win. The buyer wins, the seller wins, the realtor wins, the loan officer wins, everybody wins. That's always going to be a lot more beneficial. We're often asked, outside of like, what's my interest rate? What are the terms? One of the big questions we get is, how much house can I afford? So whenever we're looking at how much house you can afford, it's, your monthly budget, it's the loan type and the programs. It's, you got to utilize the MLS to find the house. There's going to be some escrow with title. You've got your mortgage interest rates, your debt to income, and then a mortgage affordability calculator. So the quick and kind of easy way of looking at this is you take your monthly income and you divide it in half. You deduct expenses. You deduct your expenses that are on your credit report. And basically, that's going to be your max housing payment. You can also take that monthly income. When you divide it in half, you can divide it by 0.8, and that should give you a fairly good purchase price. With these rates, it may be 0.9, 0.85 at the higher the interest rate. The lower the interest rate, the lower that number, so the more affordability. For example, $10,000 in monthly household income, 50% of that is $5,000. So you have $3,800 in total monthly liabilities. That gives you $1,200 to devote towards a mortgage payment. So that's going to give you about $150,000 purchase price. And so one thing, whenever you're doing this, your monthly income is whatever you're paid. If it's self-employed, your income is going to be derived from your tax returns. If we're going conventional, these are conventional standards. Self-employed, your income is derived from your tax returns. If you're a W-2 employee, it's going to be derived by your W-2 and your paycheck stub. They're going to look at both. If they're increasing and it's because of a raise, we're going to get to use the increase. If it's increasing just because of hours worked, we're going to look at an average over the last 2 years. If it's increasing because you now get bonuses or commission, we're going to take a look at that as well. Also, if you receive child support, Social Security income, separate maintenance or alimony if you got divorced out of state. If you receive any of that, that number also goes into our household income. All right. And likewise, if you're paying any of that, well, not Social Security, but if you're paying child support, if you're paying spousal maintenance or some sort of alimony, all of that goes into your liabilities. So the numbers can look dramatically different pretty quickly depending on where exactly everything falls and what your debt to income looks like. $10,000 on somebody who has less monthly liabilities is going to be able to buy significantly more house. $3,800, probably got two pretty nice cars in that, hopefully. And then the other thing is, one thing we also hear now that you know how to kind of calculate how much home you can afford, we hear a lot of people saying they want to wait. They want to wait for interest rates to go down. I used to always say this without the real knowledge, but now I actually have the real knowledge. The best time to buy is always now. They're waiting. When you factor in appreciation and amortization, will never benefit you. The next scenario I'm going to show you, the next slide I'm going to show you, has a 1% interest rate drop in 6 months and a 1% interest rate drop in a year. And what it shows is that when you factor in the appreciation and the amortization, which is the payment portion that goes to principal on the loan, you're going to benefit. So this is the cost of waiting. This is in Florida. The loan today, which this was a couple months back, so seems like years. The loan today is at a 6.5% interest rate. Your property value is $1 million. You put 20% down, you get an $800,000 loan on a 30-year fixed rate mortgage. Your down payment is $200,000 cash. That's out of your pocket or out of the equity from a previous sale. Your interest rate is 6.5, and your APR is 6.605. So the APR factors in the loan cost when you're dealing with the interest rate. So in 6 months, the rates go to 5.5. You have appreciation. So all the homes that have sold in between now and then have made this home about $20,000 more expensive. I can also tell you this right now. The indexes just came out from Case-Shiller. They're all predicting in this last year that we will finish the year with a 5%, about a little over 5% appreciation nationwide. So, of course, there are some pockets that lost money, and of course, there are some pockets that had 10% appreciation. But in this market, homes are still appreciating. There is a serious supply issue, which is definitely helping homes maintain their value. So the same home, but now it's $20,000 more expensive. Your loan is $16,000 because that's the new 80%. Your term is still 30 years. Your down payment is now $5,000 more expensive, well, $4,000. You get that lower interest rate, and you get about the same cost. It's about a tenth of a point in cost. And then, this is what it looks like if we waited 1 year. In 1 year, you're going to be at 2.95 appreciation, which is going to be $1.03 million. It's an $823,000 loan. So the loan's going to be about $200 more expensive a month. Same 30-year fixed rate. Down payment went up to almost $6,000. You get that lovely 5.5, and you get a 5.607. So these are what the base numbers look like. When we come over here and we look at it compared to your 30-year fixed, when you waited 6 months, you save $420 a month in payment because of that 1%. And when you waited 1 year, you save $380 a month. You don't get the $20,000 in appreciation. That's my money that I get to keep if I were to sell my home that I bought today. And you also didn't pay down your mortgage almost $4,000. So the total cost to wait is about $24,000 for this person. They waited and they actually came out about $24,000 in the worst. Now let's factor in what does it look like if we're going to refinance. This is in Florida, Texas. It would be a little bit more expensive, closer to $4,000 or $5,000. The payment difference is 2,526. So you deduct both of these numbers, and now we get $19,000. So it's about 1.9% beneficial to buy at the higher interest rate. If you wait 1 year, the numbers just get that much better because you get the appreciation and the amortization. Oops. One thing to remember, these numbers are a lot larger. Realistically, if we were talking, a regular home, this number would be like $3,000, regular home being like 400,000. This number would be like probably $8,000. But it's still more beneficial to you. If you can time the market, great. But when you factor in rents, when you factor in breaking leases, when you factor in that kind of stuff, timing the market is never going to work. Not to mention that Fannie Mae and they're forecasting a 6.5% interest rate through most of 2024. That's supposed to bring 5 million buyers to the market. So once these new interest rates start to kind of become common knowledge, we're expecting a lot more demand for homes. Inside of that demand, you're going to end up, home prices are going to rise pretty quickly. There's not enough supply right now out there. And when you get a lot more people wanting to buy and interest rates lowering, home prices are going to rise. And, we always say in the mortgage industry with interest rates and home prices, they fall twice as fast as they rise. In this case, they rise twice as fast as they fall. So it's going to take a lot of turmoil in the market to get the house prices to start moving downwards. But once the turmoil clears, there's always going to be a bull rush and people are going to want to get into more homes. Let me check the questions. So your student loans do count against you as your debt. But if you're currently in a payment deferred situation, we're going to take 0.5% as your payment. So for instance, you have $30,000 in student loan debt. So $30,000 would be, if it's in deferred status, would be $150 a month into your debt. So it's pretty good. It's not a very bad situation. $100,000 in student loan debt, which may sound a little bit out there, but it's really quite common. Is about a $500 a month payment on your debt. So don't let student loans be the determining factor of if you buy or if you don't buy. Also, if you have a fully amortizing payment that's really, really low on your student loan debts, that's the number we're going to use if it's on the title, if it's on the credit report. The LLC, whenever you're putting a loan in an LLC, you act as a guarantor for the most part, and you're really only going to put loans in LLCs that don't do traditional debt to income calculations. Like I said, Fannie Mae, Freddie Mac, VA, FHA, all require you to close in your personal name. Non-QM and private money, hard money will allow you to close in your entity. You wouldn't want to close in an entity name if you're buying your primary residence because you won't be able to take all the homestead exemptions. So just a few things to kind of think about there. And then, for the most part, you can always refinance in 6 months. It just takes a lot more interest rate it takes the interest rate to fall a lot more. because in the refinance, it's literally payment versus payment, and it's not necessarily what the interest rate says. And also, you just want to remember that whenever you put a big debt on your credit typically goes a little bit negative. You have to show that you can handle the payment of the new debt for your credit scores to recover. You know, whether that credit score drop is 5 points or 30 points, I have no idea. They guard that stuff pretty closely, but it's just something to consider. So using your future rental income to qualify for your mortgage. Okay, so on this, if you're a realtor or if you're an investor and you're kind of trying to figure out how you're going to come up with 20% down or 25% down, depending on what kind of property you want to buy to invest in, you can always convert your current principal residence, your primary residence that you live in now. You can always convert it to a rental. What that consists of, it consists of a 1-year lease, and it consists of 1 to 2 months of deposited checks. What that looks like is it can be a security check and first month's rent. It can be first month's rent and second month's rent. It can be first month and last month. Most of the products do only require 1 check. So it would be, you know, it's typically the security deposit and then the rental income. Now, you know, you refinance, you were smart, you bought your home, you refinanced your home in the last 3 years, and you have a 2.75% interest rate. However, you know, the home just doesn't work for you anymore. You need to move. You know, you've just outgrown it in the last 3 years. A lot of people are not wanting to move because they do not want to lose that interest rate. Well, what we say is don't convert the home to a rental, rent it out, get the cash flow. We'll be able to count the cash flow towards your income. We use 75% of the rent. So a $2,000 rent is $1,500 a month in income. If your mortgage payment's at 2 point something, it's probably going to be about $1,200. So we'd be able to add about $300 to your income every month. And then all you do is you just get that signed. They do not have to move in the day you move out. So you can sign them up, and their move-in date can be as little as you do not want it to be greater than 60 days out. So they sign the lease today, they give the security deposit, they move in 60 days, you go make an offer on a home, you close in 45 days. In 45 days, we close, you take 3 days to move, and then you still get to clean the house at your own leisure for your new tenants. So, you know, if you hear people not wanting to move forward because they have a great interest rate, there's a way to make the most of everything. 5 pitfalls to avoid as a real estate investor. So number 1, you make your money when you buy. Someone once told me the only negotiable number in the entire process is that purchase price. Your rehab is your rehab. If you go cheap, it's going to be cheap. If you go expensive, it's going to be expensive, but the cost should be pretty much the same. You know, when you go to sell your home, you're paying holding costs, you're paying all these costs. You know, you might not be able to be as price insistent as you want when it comes to selling the house. Next is have a backup plan to your backup plan. You know, when things go wrong in real estate, 9 times out of 10, maybe 99 out of 100, there's usually only one solution, and that's more money. Whether it's, you know, covering holding cost, whether it's something was missed in the rehab quote, you know, whatever it is, the typical solution is more cash. Number 3 is in God you trust, verify everyone else. Don't take people's word for it. Don't send us a deal where the wholesaler is telling you it's worth 400,000 and you didn't do any research on it. It's, you know, you've got to know your numbers better than the people you're trying to buy from. Market, connect, and repeat. So basically, never put the phones down. You always have to be marketing. Always, always, always. It's just something that, you know, is just, it's the first thing we want to quit, and it's the last thing we should quit. And then follow up. Some sales statistics will show that not many sales are made on your first contact. The vast majority of them are made in the double-digit contacts. People like to work with people they know. If you're talking to someone on the phone 5, 6, 7, 8, 9, 10, 11, 12 times, you're going to develop some sort of relationship and commonality, and that's going to help you to close deals. You have to be around. What have you done for me lately? Here's a little something on how to determine whether a deal is good or not. So you want to know your numbers better than anyone else. So you're fixing flips. You want to try and buy them at less than 70% of the ARV, or the actual amount of profit as a dollar figure that you want, or anything you determine that you need. I used to have a buddy who wouldn't buy any home built before 1970. That same buddy also, every time he bought a home in the same neighborhood, he would always reset people's rent to try and get them to where they were all expiring in June. Like he wanted them all in expiring in that April, May, June, so that he could, so that he would have the strongest market to lease them out again. Until one year, 3 of his properties were vacant at the same time. And so he had 3 rentals and he only bought 3 twos. Like he picked his houses out very, very, very particular about the homes he was buying. Like he ended up putting the exact same home on the market 3 times. So he was showing it to the same person. He wasn't the realtor, but his realtor was having to show the house to the same person because they were looking at each one. And then they were negotiating against each house, but he was the landlord of all of them. And so that day he told me he was not doing that anymore. You're buying your hold, a little bit more lenient on the percent that you buy of ARV, because you're going to keep the house. So you're going to get appreciation. You're going to get amortization. You're going to get ideally a tenant paying your entire mortgage payment. 1% rule is the home should rent for 1% of the sales price. And then, do you have your own metric that you want to put in there? Ground up construction, not all land is created equal. Does it have frontage? Does it have access to other things? Does it have electricity? You just really want to make sure you're looking at all that. What is the highest and best use? And then what kind of permitting issues may you run into? The top tender, I don't know why I can't talk. The top 10 lender junk fees smart investors avoid. So basically, appraisals and other lender fees. We're waiving our appraisal fee right now. We do a desk appraisal in-house. Loan rate points, what you quoted them, were they quoted? Do you have extension fees? What are they? Prepayment penalties, servicing fees, payoff fees. If you're paying $25 a month to make a payment to someone, you probably want to look at that, make sure you're factoring that into all the cost of the loan. Payoff fees, are you going to charge me to buy my, charge me to ask how much I owe you, which I already know that number. Inspection fees, if you have 6, 7, 8, 9 draws at $200 an inspection fee, that's also all of a sudden a pretty large cost. How quickly do they fund draw requests? Are they adding additional wire fees? And do you pay interest on undrawn rehab budget? Undrawn rehab budget is the way a lot of these guys are, incentivizing rates, giving other programs. They're charging you on money that they haven't given you. So it's 100% profit. Where to find deals? Well, the first place, Real Estate IQ. These guys are going to be the #1 help to getting you the deals that you need to do. Also, don't be scared to utilize the social media. Talk to your friends in your circle, talk to everybody People know people who are selling a home. People also they think selling a home takes a lot of effort, and when it doesn't necessarily. So there's a lot of opportunity in the friends and followers that you have on these websites. Where else? Investors, all the meetings that you can go to. Wholesalers, drive for dollars, probate attorneys, divorce attorneys, bankruptcy. All of these guys are all going to be available to you. And then where's #1? Real Estate IQ. We want to really thank them for letting us present to you guys. It's always a pleasure. We're going to touch up our slides a little bit and make sure we can take it into the new market at the turn of the year. A lot of people ask us, I see this rate online. There's wholesale rates versus retail interest rates. We are a wholesaler. Our rates are cheaper. Our overhead's cheaper. Everything is just a lot cheaper. We like to think of ourselves as the candy store. You can come in and you can get any loan. We do conventional loans, FHA, VA, private money, hard money, non-conventional. We do some construction loans. We try to make sure we have loans available for everybody, especially our investor partners. Go visit blinklending.com. We have an instant pre-approval on there. It will work instantly. And you wouldn't go shopping without your wallet. So don't go house shopping without a pre-approval letter. Let's keep in touch. You can find me on all of these. Send me an email to rick@blinklending.com if you want me to send you a copy of the PowerPoint. And again, just want to thank Real Estate IQ and thank all of y'all for a fun presentation. Well, fun may be an exaggeration. Let's see here. My final questions are, all right, do you have any recommendations on easy use free CRM? Unfortunately, I do not have a recommendation for that. It's just going to be, the one that gets you, that kind of does it the quickest and the best. I wish I had a recommendation though, but I do not. Or any other questions before we shut off? Valentina, are you there?
I'm here. Thank you, Rick. I was waiting if anyone else had any more questions. If that's not the case, thank you again for attending today, everyone. Rick, someone is asking you, where are you located?
Physically, I'm located in Santa Fe, New Mexico, but license-wise, I'm licensed in New Mexico and in Texas. And here's my email address.
That's great. Thank you.
I'm not yelling
again. Yeah. I will share it to everyone.
Share because it wouldn't let me go to everyone.
Yeah. Now it's there.
All right.
I hope everyone is okay and has no more questions. And thank you, Rick, for this amazing webinar. I hope you have a wonderful day.
Thank you. Have a great one.
Thank you for attending. Bye-bye.